The U.S. presidential election is coming up fast, and regardless of what country you live in, there's huge implications for your money, for your investments, and your retirement. Now, in this video, I'm going to show you two key numbers that you need to be watching, and depending on who wins, take the appropriate actions. Now, these are the two numbers that the smart money is paying attention to, and you should too, so stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. Now, I believe the only real security we have in life is to take responsibility for ourselves, to learn how to make money, grow our money, protect our money, so we have options in life because the world's changing fast. Now, if you agree and you want to hear more about these topics, click the like button so more people hear them. Hit the subscribe button and the bell notification so you're notified every time I put new videos out. Now, today we are talking about the two numbers that you need to have your eyes on if you want to survive and thrive the market that we are in right now and through this election cycle and of course beyond. Now, these two numbers and how you navigate them are going to have a huge impact on your financial future. Now, one of these numbers has the potential to dramatically change depending on who wins in November. So we're going to need to pay attention to that number, very close attention. So you're already asking, what are the two numbers I'm talking about? Well, I'm talking about interest rates and I'm talking about tax rates. So let me dig in and explain. So first, let's talk about interest rates. Then we'll talk about tax rates, and then we're going to talk about what you should be doing and what type of actions you should be taking. So first, talking about interest rates. And of course, before you tune out and before you think that interest rates don't affect you, you don't have any debt, you don't have any loans, you don't plan on buying a house, you don't have any cars, take on new debt, whatever, just realize that while it may not affect you personally, they do affect you indirectly. Now, as you already know by now, at least if you've been watching this channel, then for sure you know that U.S. interest rates and really global interest rates are the lowest levels they've ever been in history. Most of the world is already having negative interest rates. The U.S. is basically down at the lowest level in history. And while that sounds great if you want to borrow money, it's actually really bad for us investors. It's really bad for the investors that are baby boomers that are trying to retire right now, because as they're trying to retire, they need the interest rates up so they can get the income from their investments. Now, when interest rates are low, it gives us as investors less options to generate the income from our savings. And of course, that's what the retirees need, is income. Of course, I like to invest for income now as well, and so should you. But basically, when the interest rates are low, it becomes very hard to generate that money. And it looks like the low interest rates are not going to change anytime soon, regardless of who wins the White House in the November election. Because as we've discussed, Fed Chair Jerome Powell already told us that the Fed plans to keep interest rates basically pegged near zero for years and years and years into the future. And neither candidate, neither political party is debating this, all right? None of them are going to challenge this. So as investors, we're basically have to continue to expect low interest rates. Now, the economic side effects for this are going to be felt for years and years to come. Now, the second number that you need to be watching is tax rates. Now, tax rates, they are a big issue for the November election. If Trump and the Republicans win, you can basically expect more of the same. Taxes would remain about the same. They were significantly overhauled back in 2018 when the Trump administration took over the White House. It was one of the most significant tax changes in the last 40 years. The tax strategy lowered tax rates, and specifically for businesses and investors in order to help create jobs. And those newly created jobs helped to lead to better opportunities for everybody. Now, this seemed to work. We saw it work in the economy and the markets, right? In early 2020, before the pandemic hit, we saw one of the lowest unemployment rates that we've seen in history. The economy was humming along. The markets were near all-time highs. And I also want to point out that this period also included record low unemployment for minorities and workers with low levels of education as well, which are groups that have historically been left behind in previous economic expansions. Now, on the other side of the aisle, the Democrats, on the other hand, they believe that higher tax rates are necessary, particularly on higher income people and businesses. Now, they argue that the economic system is currently skewed to help the rich get richer at the expense of those less fortunate. That's what they say. So by taxing the rich and using that extra revenue to fund programs for families that need more help, we're going to create more level playing field. Now, of course, there's many nuances to all this, just like there are with a lot of other issues. Plenty of different angles, different agendas for both sides of the aisle. Me personally, I've got some strong feelings on these issues, But that's not what this video is about. But you can leave me some comments if you want me to dig in more into taxes, more into the effects of the economy and things like that. Of course, as always, my goal is to help you live the best life, help you manage your financial future so you can focus on the things that matter most. So let's look at the best way to position your savings, your investments, and your retirement right now in light of these different things that are changing, these changing rates. So let's start first with interest rates. So with the Federal Reserve committed to keeping interest rates pegged basically near zero for years and years and years to come, we have to look to areas of the market that are going to benefit from historically low interest rates. So the first area that most people think of is, of course, do I hear it? Do I hear it? The housing market. You would be right if you said that. Now, most people think the housing market's going to benefit from low interest rates, and of course, those people would be right. So most people are or should be participating in this sector. I've done about 4 or 5 videos on real estate just since the pandemic hit, so I'm not going to dive deep into real estate in this video. But what you need to know is that thanks to low mortgage rates, home prices have been continuing to move higher and higher and higher, and the demographic changes in our country further help to support this trend. Now, if you own a house, I'm sure you've already seen the benefit of these prices going up because depending on where you live, the value of your home should be moving up pretty well. Some areas more than others, but pretty much everywhere is moving up right now. Now, the good news, though, is that if you don't own a home or you don't plan on owning a home, you can still participate. You can still participate in this thriving sector of the economy without buying a home. How do you do that? Well, you just buy the companies that participate. So you can buy shares of home building companies. We've talked about that in other videos like Lennar and other home builders like that. You can own stock in companies that sell home building materials. So of course, Home Depot, things like that. We've seen lumber go through the roof. You can buy into companies that sell home furnishings, home appliances, things like that. You can also benefit directly from low interest rates by investing into blue chip dividend-paying stocks, into these stock categories. Like I said, there's a lot of investors that aren't able to generate income right now from traditional places, of course, like savings, treasury bonds, things like that. And so they're forced to go into other areas of the market that they maybe wouldn't typically go into. And so one of the really big beneficiaries of this is going to be dividend-paying stocks. And it's not just the individual investors like you and I who are tapping into this great source of income. As a matter of fact, pension fund managers also need to generate income, right? And in many cases, they're moving cash into dividend stocks to tap into these income streams. They're investing into companies with reliable businesses that pay generous dividends month after month, quarter after quarter, year after year. It's a great way to take advantage of this trend. Now, if you put some of your investment portfolio into these stocks today, I believe that you're going to, not only receive the income, but you're probably going to see the price of those stocks go up. And as your wealth grows up, the stocks are going to be trading higher and higher and higher. Now, let's move on to everybody's favorite subject. And I would say that most people rank this next subject right up there with going to the dentist, and that subject is taxes. And more specifically, how can we avoid the risk of higher taxes stealing from our investments? Now, I already discussed some of the potential tax implications depending on which political party wins the election. Like I said, if Trump and the Republicans win, we can expect more of the same. If Biden and the Democrats win, we can expect higher tax rates. And this potential for higher tax rates on corporate and personal taxes has many investors starting to worry. There's several different ways Democrats could hike tax rates on businesses and wealthy individuals. In addition to taxes on profits or income, the proposed Biden tax plan has also stated it wants to raise taxes on capital gains, which directly affects us as investors, as everybody else. Now, Goldman Sachs recently put out a report, and they sent this out to businesses and investors, and basically telling them what to expect from the Biden tax plan, telling them what steps they should be taking over the next couple of months to be prepared for this. Now, in this report, which I'm not going to read you, but I'll give you the highlights of it, it basically outlines Biden tax plan and says it's expected to almost double the capital gains tax from about 20% to almost 40%. Double. Now, real quick, if you're not exactly sure what capital gains taxes are, basically they're taxes that are paid on profits of investment income. So when it comes to taxes, there's 2 different types of income that the IRS looks at. There's one that's earned income, and of course that's earning it. So that's doing work, providing goods, providing services, etc. That's where most people make their money. And then there's investment income, which is taxed at a lower rate because really two reasons. It's taxed at a lower rate, first of all, because the government's typically using tax policy to try to incentivize people into making investments. So, the government realizes that we need people to start businesses and hire people to give jobs, right? So they'll incentivize you to do that. So if you invest into that, they'll give you tax breaks. So if you invest into new research and development, they'll give you tax breaks. And we need that. The government knows we need that because we need new products. We need new companies. We need those things. And if there's no capital for businesses to grow, to develop new products, then it all collapses. So we need people to be investing. The second reason why taxes are lower on investing income is that investments are something you do after you earn your income. So you've earned your income, right? You've already paid the income tax rate on the earned income, and then you invest with the money that's left over after you've paid the tax. That's after-tax income, after-tax dollars. And then if you profit on that, you got to pay tax again on the same money that you already paid taxes on. So you paid taxes when you earned it. Now you're paying taxes again. So it's double dipping from the government. And that's the second reason why I think it should be taxed at a lower rate, right? We've already paid taxes. Now I'm paying taxes again, and we need it. So in addition to raising capital gains taxes, Biden's proposed tax bill also wants to raise business taxes from about 21% to 28%. It wants to increase the top tax rate from 37% to 39%. And it also wants to increase taxes on the middle and the bottom. So don't think you're getting off scot-free. But again, this video is not meant to break down the taxes. It's not meant to give you all the ins and outs of all what that means. Rather, I want to discuss how these tax strategies are likely going to affect different areas of the market so we know where we want to put our money. We want to know how to move, how to react, how to respond. So if corporate taxes get moved up higher, then I think we should expect an inverse reaction to the overall market surge following the Trump tax cuts. If the market moved higher from lowering taxes, then it's mostly likely going to be come down when we raise taxes. Right? At least that's what logic and of course that's what history shows us. Now, I also think that large tech stocks in particular that pay very little in tax right now could see a much bigger liability, and this could cause a significant drop in share prices. Now, I've mentioned before that many of these most popular stocks like Amazon, Google, Tesla, Netflix, they're trading at prices that are just crazy, right? They're super high compared to how much they earn, and higher tax rates would bring this issue into focus and likely cause some investors to lose confidence and then take some profits off of the table, leading to more selling. But I also think that smaller tech stocks could do pretty good in this environment. And that's because these companies generally still have low profits, which won't be immediately hurt by these new higher tax rates. Investors are excited about these companies because of the potential for future growth and not necessarily the profit levels, for this year, next year, or 2 years from now. Now, thinking about personal tax rates, it's likely that higher tax rates in the future could also kick off a wave of selling on Wall Street, a wave of selling on stocks ahead of these new rates that are going into effect. And this could especially make sense for investors who have positions right now with large gains. So if you're sitting on large profits right now, you got to think about this, right? Like right now, I could pay cap gains and pay 20%, but if I hold it and pay next year, I'm going to pay 40%. So maybe it makes sense for me to sell right now, lock in that 20% tax rate, and then I could just buy back in if I want, or hold till next year and pay double the taxes. Think about that. You're penalized for holding it a little bit longer and paying double the taxes. Now, obviously, if too many investors start to feel this way, we could see a huge wave of selling hit the market. And if that were to happen, it'd be helpful to get out of stocks ahead of that. So it potentially could happen. Another reason why you might want to consider selling your stocks early, if not even, like I said, just buying right back in just to capture that new tax basis. Now, when I look at the big picture, it's still very important to have a balanced approach to markets and not make rash decisions with your portfolio. But at the margins, there's some important areas to invest, as this election season kicks into high gear, especially when it comes to both interest rates and taxes. Now, let me know what you think. Would you consider cashing in on your profits right now so you can capture that lower tax rate, that 20%? Or are you just going to let it ride and see what happens? Let me know in the comments down below. As always, give me a thumbs up on this video if you like it. If you don't like the video, that's okay. Give me a thumbs down. But let me know in the comment because I want to know why. That's what I got for you today. To your success.